cover all other parts. So we're going straight to the definition. What is inventory? IS2. IS2 deals with inventory, and inventory is associated with, number one, typically a physical product trading company, a manufacturing company, and also there's another category of inventory that is often overlooked, right? What you call consumables, to speak, or those that items held or carried for that are to be used as part of a production process, but they are not the core raw material themselves, or that they are consumed in process of rendering services. So, but we'll not be saying this all just that way. We'll be looking at standard, we'll take the definition, and we'll go to the core part of what we'll be dealing with under inventory. So I go to paragraph 6 of IS2 and I read verbatim from the standard. It says, inventories are assets, A, held for sale in the ordinary course of business. So that asset that is held for sale in the ordinary activity of an entity. The question is, what is the principal, what is the main business activity of an entity? So that asset held for sale in the ordinary course of a business is inventory. Number two, the standard also defines our inventories to be assets that are in the process of production for such sale. That asset that are in process of production for sale, either as raw material or work in progress or partly finished goods. That also forms part of the inventory of an entity. Then thirdly, the one I said is often overlooked or that is rare is assets in the form of materials or supplies to be consumed in the production process or in the rendering of services. The items called consumables, these items, they are not the core raw materials, they are not the semi-finished goods or partly finished goods themselves. However, they are either used in the production process or used in the rendering of services. Let's take an example. You have an office and we use, papers, say A4 size papers or other size papers for either photocopy, for printing, for publication, and the rest. For an entity that is not into a publishing business, say you're a law firm, you're an accounting firm, you're a professional services firm or entity, so your inventory, your stock of A4 paper, your stock of even stationery as a whole, stock of say your lubricants used to power your plant, your generator, and the rest. All of those things come under part of the inventory. So they come under this third category. There are those assets held in the form of materials or supplies to be consumed in the production process or in the rendering of services. So those are the three categories of inventories. So let's go ahead and take the definition once again in a single swoop. Inventories are assets, A, held for sale in the ordinary course of business, B, in the process of production, that is assets in the process of production for such sale, or C, assets in the form of materials or supplies to be consumed in the production process or in the rendering of services. So this is what we call, or these are what we call inventories. So as I mentioned before, it depends on the principal, on the ordinary activity, or the specified main business of an entity that will give a guide as to what constitutes an inventory or the items that constitute inventories for that entity. So we want to practicalize it. A real estate company that is into the building and selling of houses, the housing units it constructs and sells come on the inventories. Another company that is into acquisition and selling of land, for example, is land holdings will come under its inventory. We look at a motor vehicle dealership, for example. So the collection or the fleet of vehicle in his showroom, on his warehouse or store that it sells comes under inventory. However, the vehicle for an auto dealership it uses for run around, for marketing, for publicity and the likes, would not come under inventory because they are not held for sale in the ordinary course of business. Neither are they in the process of production for such sale, or neither do they form part of the material used in the production process or in the rendering of service. So that is if for a stockbroking firm, for example. Now the question is the shares or the equity instrument item they buy that they trade in, right? Do they qualify as inventory? The standard says no. So when you go to IAS2, it gives exemptions. The IAS2 applies to assets that share the characteristics apart from those ones that are financial instruments because they are measured and reported under another standard called IAS 32 financial instruments presentation. Yeah, so for a stockbroking firm that's into buying and selling of equity instruments, while they may tend to seem or look like inventory, but they are not. For the purpose of IS2, they are rather reported in line with IS 32, which is financial instruments presentation. In addition, for biological assets related to agricultural activity, those collection of items are not inventory to be reported under IS2. So those are exceptions. They are not within the scope of IS2. So for those assets that are held for, say, in the ordinary course of business, for those assets, that are held as part of the production process for such sale, for those assets that are part of the production that are held, to support the production or to aid the running of services are in themselves inventories. So that is the classification, and the specific purpose of a business or the main business activity function of an entity define, those activities define what to come under the ambit of an inventory or inventories. So we just want to give that background. Now, want to hop over and go straight in the typical financial statement you must have prepared under IFRS or in your financials. What are those things that should be seen in your inventory accounting policy? We know there is accounting policy for inventory. What are the components? What are the elements? What are the compositions of the contents of the item that should be contained in your accounting policy and that should be disclosed in your financial statements? In subsequent edition or episode, we'll be dealing with all of the meaning of cost, component of inventory, the cost elements, the costing technique, the cost formulas, and the rest of them. But I want to focus on what are the elements or what are those compositions we ought to see when we talk about inventory accounting policy. And that takes us to paragraph 36 of IS2. So I'm going to read out what paragraph 36 says on disclosure. So in a typical IFRS financial statement, what are those items you ought to see contained in an inventory accounting policy? And also, what are the disclosures associated with inventory that should also be seen in a financial statement? Number one, in line with IS 36. The accounting policy adopted in measuring inventories, including the cost formula used. So in a typical IFRS financial statement, which contain inventory, unless the financial does not contain inventory for whatsoever reason. You see, when an entity is not a manufacturing firm, when an entity is not a trading firm, it is likely that any carriage of inventory will be for the purpose of rendering services or to support other operation of that entity. Say the A4 papers, the lubricants, the stationery, and the likes of them. They're all inventory. However, in practice, organizations have what they have threshold of materiality. They have materiality threshold, materiality band. When certain expenditure are incurred and did not fall within the materiality threshold or band of an entity, such spendings are expensed. So they are not capitalized for the sake of trying to carry them as inventory, because there's a cost-benefit consideration. A cost-benefit consideration in financial reporting, or what you may want to call, when the cost outweighs the benefits, then we need to rethink the need to give them detailed consideration into a long-term reporting of an item. So for an entity that is not into manufacturing, that is not into trading, right, and that carries all those other consumables as inventory, you may not see it in the financial statement where the expenses incurred in acquiring those inventory, that category of inventory, right, are not material to be carried in their book as current assets, meaning it is not worth the sweat of the detail of reporting and maintenance in the financial reporting system. So when they not worth that threshold, such spendings on paper boards, stationery boards, lubricant boards, replaceable boards, when the threshold are insignificant, they are written off. They are just explained, that's it. However, for an entity that has inventory in the financial, the number one thing that must be seen in an IFRS financial statement is the accounting policy on inventory. And that accounting policy contain the meaning of inventory, the items that are inventory in the circumstance of that entity, then including also the cost formulas used as mentioned in paragraph 36. So number one, in a typical IFRS financial statement, where there is inventory in the statement of financial position, there must, either for the current year, the current reporting period, or for the comparative period, so long as inventory is presented in the face of the statement of financial position, there must be a disclosure containing, there must be, what you call part of the component of statement of significant accounting policies. There must be one for inventory that describes, that communicates to a standard reader the meaning of inventory in the circumstances of an entity, the cost formula used, the costing techniques, and the rest of them contained in typical policy that will enable a reader understand what is inventory in the context of that entity and to explain or understand better the inventory presented in the face of state of financial position or disclosed as notes to a line item of inventory presented in the state of financial position. That's number one. Number two, the standard says an entity must disclose the total carrying amount of inventories and the carrying amount of classifications appropriate to the entity. So an entity must disclose the total carrying amount. Let's take, for example, 20 million naira for inventory. It must be disclosed in the statement of financial position. Then in the note, it is not enough to disclose the total. The standard say, give a classification of the appropriate categorization. You have to disaggregate. The inventory of 20 million, what portion of the 20 million is for raw materials? For example, what portion of the 20 million is for work in progress or partly finished goods? What portion of the work in progress is of finished goods, finished products? And what portion of the work in progress form part of the consumables mentioned, right? The consumer spares. Or even if there are material inventory that are, that are on transit, you may want to include a subline item in the note that this portion is a transit, inventories or goods in transit. So the summation of the raw material class, the summation of the partly finished goods class, the summation of the finished goods class, the summation of the raw material or goods in transit that is not within the premises of an entity, we total up the amount of inventory presented in the face of statement of financial position. So we've mentioned disclosure of accounting policy. We've now mentioned that the disclosure of the total current amount and the categorization of inventory into their various classes as either raw material, partly finished goods, consumables, and maybe inventory in transit. Number two. Number three, the third item we will see is the carrying amount of inventories carried at fair but less cost to sell. Sometimes, when you go to paragraph 9 of IAS 2, it stipulates the subsequent measurement basis for inventory. That inventory is measured at the lower of costs and net realizable value. The lower of cost and net realizable value. Even though there's an exception to that when it comes to raw material, but we'll deal with it in subsequent edition. So generally, inventory is measured at the lower of cost and net realizable value, NRV. However, there are certain inventories, agricultural produce, at the point of harvesting agricultural produce, they are measured at fair value less cost to sell. So the first input valuation given to agricultural produce that form part of the inventory for an entity is not measured at cost, and neither is it measured at net realizable value. Rather, it is measured at fair value less cost to sell. So the standard says in paragraph 36, sub C, where an entity carries such inventory, those inventories measured at fair value less cost to sell, the disclosure must reflect that this portion of the inventory is carried at fair value less cost to sell. That's number 3 disclosure. Number 4, the amount of inventories recognized as an expense during the period. This is the amount of inventory expense in the period. Computationally in accounting, when we say opening inventory plus purchases plus carriage inward, less return outward, less closing stock, we get our cost of sales or cost of goods or cost of goods sold. Generally, that assumes a finished product component of expense. There could be raw material expense, there could be direct labor component, there could be direct expense component in a manufacturing setting. Therefore, cost of sales is a line item that is not always made up of only direct material costs or inventory consumed. There could be other components like the labor costs or like the direct expenses. So the standard stipulates that for the portion of inventory expensed or consumed in a reporting period, that must be disclosed. Why this is not obvious? When cost of sales is presented in a typical financial statement, it is not clear absolutely that that cost of sales is made up of only inventory. As I've just said, there could be labor cost component part of it, there could be direct expense component part of it. The standard requires that we disclose as well that the inventory consumed or the inventory expense in that period is, say, 20 million or 10 million. Maybe out of an 80 million line item of cost of sales. So let's take note. So part of the disclosure is the disclosure of the cost of inventory expense for that period, meaning the part of the inventory sold that generates the revenue that is to be matched with it in arrival at the gross profit or other line item of profit. So for that standard, the standard says we have to disclose the amount of inventory recognized as expense in the period. We have to disclose it. And as we disclose for the current period, we also disclose for the comparative period in brackets. That what we call narrative disclosure. Apart from the note that is aggregating summation of amounts or line item or subline item into getting a total, we have narrative or descriptive disclosure, where we write that the amount of inventory consumed in the period is, say, 20 million naira. If we're in 2024 reporting year end, for example, when we write the amount of inventory consumed in the year or in the period was 20 million naira, then we're going to open a bracket, because if we're in year 2024, the comparative of 2024 will be 2023. So in the bracket, to put 2023, they'll write the equivalent amount of inventory expense consumed in the comparative period or year 2023. So that is how it is done. So the standard says we have to disclose the amount of inventory recognized as an expense during the period. Now, going to sub E, paragraph 36E, it also says in a financial, the amount of any write-down of inventories recognized as an expense in the period in accordance with paragraph 34. You see, paragraph 34 talks about writing off. When you measure an inventory, you compare the cost and the net realizable value. And when the net realizable value is lower than the cost, so the cost of inventory is written down to net realizable value. So there's, in quotes, a form of inventory impairment, even though it's not called impairment, right? That write down is an expense. So when there is a write down of inventory to net realizable value, that portion of the write down needs to be disclosed. It may be contained as part of your expense towards arriving at the profit or loss for that period, right? But the standard requires that part of your disclosure for inventory should reflect that portion written down as a result of net realizable value being lower than the cost for that reporting period end. We'll go to the next one, and that is number F of paragraph 36 of IAS 2. It writes about the amount of any reversal of any write down that is recognized as a reduction in the amount of inventory recognized as expense in the period in accordance with paragraph 34. When write down occurs in a period, in a subsequent period, it is possible for that class of inventory in particular, the NRV or net realizable value in the subsequent period may be higher than what it was in the outgone period. Let's say you've written an inventory, right? You've written it down by 2 million naira or $2 million or 2 million pounds is a write down, right? Now, in the following period, in the subsequent period, there's in quote an appreciation in the fair value less cost to sell, right? Fair value less cost to sell, for example, giving you an amount more than that, or giving you an amount that recovers the 2 million you have written off before. What did you need to reverse the previous impairment you had recognized? When there's a write down to net realizable value and the subsequent period, when you do a comparison between the cash and net realizable value, and the net realizable value is now high in such a way that is either it equates or recovers a portion of what I had written down before. This time requires us to write it back. That's what we call reversal of write down impairment, reversal of write down to net realizable value rather for inventory. Is a reversal. So that reversal is an income. This time requires us to disclose where such occurs. However, let's take note, whenever there's an increase subsequently in net realizable value, the amount of reversal is limited to the amount of the write down earlier recognized. There is no reversal that is done that goes beyond the amount that was previously recognized. If a write down of 2 million naira had been recognized before, and there's now an appreciation in quotes, right, in the value of that inventory, the maximum amount you can reverse is the 2 million you had ab initio written down on that inventory. So this disclosure is required. The next one, number G, writes, we should disclose the circumstances that led to the reversal of write down of inventory in accordance with paragraph 34. So when there's an appreciation, I'm using that word appreciation, when there's an increase in value on an inventory of a class of inventories that you had written down before to the NRV, to the net realizable value, when there's an appreciation, something must have occurred. There must be an occurrence or occurrences of such. There must be an event that necessitates that increase leading to reversal. So the circumstance governing the purpose, governing that increase or that recovery, so to speak, of the previous write down, has to be disclosed. So it's not enough to write down your inventory to NRV. Is it enough to reverse it and disclose? You also need to disclose the event, the conditions, the circumstances surrounding the reversal or surrounding the appreciation in the NRV of an item of inventory. That is number paragraph 36G. Lastly, paragraph 36H states the current amount of inventories pledged as security for liabilities. The current amount of inventories pledged as security for liability. When an entity takes a facility or takes a loan, the loan may warrant the need for a collateral. So the entity might have included or might have submitted or might have given title to its inventory to the lender. It could be a bank or that kind of financial institution. So when there's that lending and when there's that collateralization, that inventory is used as part of the collateralization process. This now requires an entity that has gone into such to disclose that social portion or this part or this amount of inventory has been used has been pledged as collateral for liabilities, originated or incurred. There's a kind of disclosing that that this amount of inventory does not just belong to that entity. No, that a portion or all has been used as collateral. An example, when there's a fixed charge, when a lender has a fixed charge on the assets of an obligor or a borrower or an entity that has come to borrow, a fixed charge is a legal entitlement of a lender to specific assets of the counterparty of the borrowing entity in the event of default. So when inventory has been used as a specific or fixed charge, The lender has the right to repossess, to take ownership of the specified item covered by that fixed charge. So in that case, an entity will need to disclose that the inventory has been pledged as collateral for certain liabilities incurred or loan taken or facility taken. So the disclosure, where there is no such, an entity could as well disclose that no part of the inventory or no portion of the inventory or no item of inventory has been pledged as collateral for any facility. So that is it. So we are done with our first episode. So this is a rundown. In a typical IFRS financial statement, the disclosures concerning inventory should cover the accounting policies itself, defining inventory generally, and what items constitute inventory in the context of the reported entity, the cost techniques, the cost formula used, and how the entity treats, of course, right down to neutralizable value and reversal. 2, the entity has to disclose the total amount for inventory and the categorization or disaggregation into raw material, partly finished goods, consumables, and probably inventories in transit. Thirdly, any portion of inventory written down to NRV, an entity is required to disclose it. Number 4, the portion of inventory consumed, the portion expense, like your inventory containing your cost of sales for that period. It may be obvious in the face of your statement of profit or loss, or where it's not obvious, a note will have to clarify the specific portion of inventory expense incurred or consumed within the period. Then we're talking about where there is a write down, the portion of the write down, where there is a reversal, the amount of reversed, and also the reason for the reversal or the circumstances or events that led to the arising of an increase in NRV over what it was written down to in the previous period. And lastly, the current amount of any portion of inventory pledged as collateral for any liability incurred. We want to thank you for being with us. We want to implore you to subscribe to our channel, share our links. We are going to come up every day and do 30 minutes end of day IFRS and Spotlight, covering various areas of the standard and then dealing with further parts. So please subscribe to our channel, share it widely, use the chat bot, use the chat field or chat box to make your comments, to make a question. Let's have your thought on this and other areas you may want us to share in this regard. So see you until you come your way again. My name is OJ Samuel from OJ Inspiration Limited. Thank you for joining us in this edition of End of Day IFRS Spotlight. Thank you and bye for now. Bye.